Invested Agents presents Real Estate Action Live. Woo!
Yes.
We're going to do something different. Multiple guests answering a single question.
This will be a fun, fast-paced hour with amazing guests.
And that is how you're going to win all day, is to empower your people.
Too many agents are trying to figure out, well, how do I get my buyer's offers accepted? It's easy. Offer the highest price. It's not rocket science.
When you're a realtor or you're doing something in real estate, you have to flip the view of what you're looking at, and you start looking at what other people are doing.
So it's really just personality based, and then having people learn the ropes in an effective way.
Focus on just being there for people and providing value.
I don't regret what I did because it really made me hustle and work hard.
Better than we've ever been. We just had our first six-figure month. That 70K just jumped to six figures.
I'm all about like building up your knowledge base, building up your mind, building up your spirit, and just slay the day.
We're always looking for people to come along and help us with our journey as well. We can also contribute and help them develop their skills.
Thanks for having me. This is super cool.
Yeah, great. No, it's been awesome.
It's an honor to be here. I appreciate you guys.
Awesome. Thanks for having me.
Hi, Haley. Thank you. Good stuff.
Chris, I'm so honored to spend time with you live, teaching thousands of real estate agents how to build their brand and not be a commodity.
Good morning.
Good morning. Another episode of Invested Agents Presents Real Estate Hacking Live. And we're going to be talking about something I've been, we're both really excited about. And we've been excited about, really, it's kind of why we got involved in real estate.
Exactly. Yeah. So we're going to be talking about this morning with 6 real estate experts about the benefits of passive real estate investing. So they have amazing feedback to give about this topic, and we can't wait to speak with each of them. So thank you for joining us this morning.
So if you passively invest in real estate right now, do me a favor, like drop a fire in the chat. We want to know that like you're super excited and you're fired up about passive investing. But if you don't, and you plan on this year making your first passive investments in real estate, they drop a thumbs up or a high five, because we know that like you're excited, you're ready to get going. So without further ado, let's bring up our first guest.
Let's get started. Okay, so we have Tarek Moussa. So hi, Tarek.
Hey, morning guys. How you doing?
Good. Thanks so much for joining us this morning. So let me just give a little bit about Tarek. Tarek is a former BlackRock employee and current director of investor relations with Disrupt Equity. His focus is on capital raising for large multifamily acquisitions throughout the country. So welcome.
Thanks for having me, guys.
Hey, Tarek, how you doing?
Awesome. Beautiful day here in Houston, Texas. Ready to make something happen. Help you guys.
It has been a nice day after several crummy days. With your background with BlackRock and your current project with Disrupt Equity, raising money for all kinds of just beautiful multifamily assets across the country. Definitely wanted to have you on for this show. So passive investing. So the question of the hour is, what are the benefits? And related to the conversations you're having with investors, like, so when you're having this conversation with investors, why they're interested in investing in some of the opportunities that you're presenting, what are the benefits that you're finding they're looking for in their passive investments?
Yeah, great question. So it's kind of interesting. I mean, I'll kind of relate this a little bit to my time over at BlackRock as well as time here, right? I think they're fairly similar in a lot of ways, but one of the big differences, of course, is that here at Disrupt Equity, we're working with a lot of individuals and entities, and let's just say, small to large entities and folks with their wealth. Whereas with BlackRock, they're looking at countries, right? Sovereign wealth funds. You're talking about trillions of dollars at a time. So it's similar kind of aspect, but different scales. But generally speaking, with what we're doing at the end of the day, the reason what we see all the time is that our investors, folks that want to work with us, they might be working a job or they might have their own company, right? But at the end of the day, everyone's goals are typically aligned in some capacity towards achieving some sort of time freedom, right? Not having to work all the time or give up their time for a job. Flexibility, let's call it. But the reality is that life is expensive and there are still bills to pay. So what they come to us for is figuring out a way to say, hey, here's what I've worked for previously in the past. take this and help me avoid having to keep working going forward, right? Let's automate this process of bringing in capital and ultimately bringing in passive income, right? And real estate is one of the best vehicles for that. And, obviously I've come from the world of BlackRock and the financial markets and whatnot. And even from there, I still believe that real estate is easily one of the best asset classes to really invest in. And one of the realities is that in real estate with this passive investing, you get to basically move up a tier, right? Where instead of having to do the day-to-day operations of working a job, you basically get to give your capital and let someone else do that. Yes, there's always going to be someone putting in the work and the effort, but it doesn't have to be you, right? From your side of things, you should ideally level up, quote unquote, to do the diligence up front, determine, hey, is this a property that I am interested in? Is this a sponsor team that I do trust and I am willing to work with and give my capital to? And once you've done that and you feel comfortable with it, then you basically sit back and let the money come in, right? Obviously, let's take it back. The returns come in, and that could be either as cash flow or as capital appreciation over time. But the whole point is that you get to be a little more passive and let what they call true mailbox money be achieved. And really, real estate tends to be one of the best vehicles for that.
Yeah, I hear that all the time. It's they know they should invest in real estate, but they don't want to own. They don't want to deal with the Fridays and Saturday calls of plumbing issues, HVAC issues, because those issues only come up on Fridays and Saturdays. It's fact. But beyond that, you touched on a couple points that I want to dig a little bit deeper in. Cash flow versus appreciation. So it's wealth growth versus income. What are you seeing and how certain investors approach what their desires are? Is it mainly just a certain income level is more interested in one of those aspects, or a certain age demographic, or what are some of the questions that really come about when they're talking to you about an opportunity in relation to cash flow versus appreciation?
Yeah, good question. And the reality is there is no one size fits all answer. I think it really depends on several aspects, but what we kind of see is folks who are at different calibers of wealth will have different risk tolerances. And what you find is that folks who are extremely wealthy, who have had a lot of success, the reality is you only have to win the game of life one time, financially speaking. So folks who have won the game of life financially and they just want to maintain their wealth and not lose it, they're happy to take a lower return, right? They don't necessarily need the cash flow. They can live off of it. They're pretty comfortable, but they want to make sure that they can keep it growing and not have to lose it. Because at the end of the day, if you have, let's give an extreme example. If you have $100 million and you make another $1 million, that's great. But at the end of the day, is it really going to affect your life materially? The answer is probably no. So they are more interested in don't lose my money versus, hey, hit a home run and make me another 20%, right? Or 10%. They couldn't care less. They just want to make sure that it's preserved in their capital. Whereas folks who are a little younger in the game, or let's say earlier on in their career in the development, they like the idea of cash flow because they're trying to get the time freedom component. And right now they may be working 40, 80, 100 hours a week, depending on what, field they're in. They want to get to the point where they can sit back and say, all right, I don't have to dedicate that time. If I lost my job or if I wanted to go on vacation, I can do that without having to worry about it. So it really depends on kind of what age group you're in and what wealth class you're in as well. And then of course, there's also the time component of, well, how old am I, right? Older folks, they tend to want to retire, and right, they're happy to keep that cash flow coming in because they don't have a source of income coming in from a day job. So they want the comfort of a consistent cash flow that comes in from their passive investments.
What type of in what ways are, because you're primarily in multifamily. I'm sure you did a lot more different projects in BlackRock, completely different business. But with what you're doing now, what are a couple different ways, and this is an entire class in itself, but what are a couple different ways that investors can get involved on a passive level? Because I know there's preferred equity positions, and then there's the more common equity positions where they may wait a little bit longer for some upside. But what are a few different ways investors can get involved in passive multifamily?
Yeah, and you kind of alluded to it. There's a whole spectrum of it, right? There really is no end to this. Depending on how deep you want to carve this out, you could hit infinite numbers of options. But really, let's just focus on two main ones, right? There's kind of, you touched on this preferred equity, which for those who don't know, it just means you're earlier on in the capital stack in terms of the priority. In the event of a bankruptcy or a failure of the property, who gets to get their money out first? And usually it's the bank is number one, and then preferred equity is number two, and then the last is going to be the let's just call them the shareholders, the common equity investors in a deal. So there's preferred equity, which is that priority position, and then there's common equity investors. So if you want safety, consistency, you're not really interested in hitting a huge home run. Not to say that it's not significant. You can easily make 10% back a year pretty comfortably with preferred equity. Then that is probably going to be the choice for you. But if you're somebody who you are more interested in compounding at a higher percentage points, but understanding that that's going to come with additional risk. And, as a side note, you can't get both. There's no way in any asset class that you can get the best return and the least risk, right? There's always some balancing act that goes on between the two. So if you're somebody who wants the safety of consistent cash flow without really much worry of losing capital, then preferred equity is where you want to spend your time in, versus if you want the higher returns, then you can go ahead and do the common equity. And that's what most people tend to do. But you kind of pick your poison, if you will. But to give some context, for our deals most recently, we have a handful of investors who want each type, right? But the way we kind of divide it lately has been roughly 20% of the capital raised on our deals are going to be preferred equity positions, right? They're going to take priority spots. And then the 80% are going to be in the common equity position. So most people do tend to sway towards common equity, but you get a handful of folks who say, yeah, I don't really need that extra return. I just want the comfort of the safety.
Last 30 seconds. Is there anything like what should be maybe the top 2 questions those passive investors should ask someone presenting them with an opportunity, whether it's a sponsor or just anyone that's presenting them with an opportunity?
Yeah, I think this is a great question, but this is how I would maybe explain it, right? And I'm going to say this with my own biases of being a little more financially competent, if you will. And I think that passive investing is a great terminology, but it still requires you to do some sort of due diligence, right? Which is going to require some work. It's not just sit back on your hands and, life will figure itself out. It never works out that way. But what it's going to take is going to 2 things. Doing your due diligence on the sponsor team, right? Making sure that, hey, I trust that, because ultimately, no matter how good the numbers look, if you don't trust the person who's actually giving you those numbers, you should probably think twice of giving them your capital. And that's something I tell every single investor, because we hear stories all the time, people who have been fleeced. And ultimately, that's why we're trying to elevate the entire industry and present people who are quality. And we know you, Chris. We've known you for years, and we know that you're in that category. But then the second question is going to be, show me the numbers, right? Show me your analysis. Don't just show me the output. Show me what were the underlying assumptions that went into it. Because if you come to a conclusion with your analysis, and it may look pretty, but if I don't agree with your assumptions going into it, then there's going to be additional difference of opinion here, and I may not want to invest in you. Ultimately, I need to determine for myself: do I agree that your predictions for the future are in line with my predictions, or are they overly aggressive, or maybe are they overly conservative, right? It could go either way, but ultimately we have to make sure that you have your perspective, I have my perspective, and we align on our perspectives. But once you have those 2 in place, then there's really no reason to move forward, and you can make things happen successfully.
Love it. Well, these things go quick. It's been a pleasure having you on, and I really enjoyed collaborating with Disrupt and everything you have going on over there. So look forward to seeing you again soon.
No, thanks for having me. Always a pleasure, Chris, and we'll be in touch for sure some more, and look forward to helping out your audience any more we can.
All right. Take care.
Thanks,
Thank you guys. Bye-bye.
All right. Okay. Our next guest is Arianne Lemire. Hi, Arianne. Oh, you're on mute.
Hey guys, how are you?
Good. Thank you so much for joining us.
Yeah, thanks for having me.
Show again. Arianne is one of our friends, and she is also you're not a medical professional turned real estate.
I was, yes.
You were? Oh,
I used to be a
I was like,
speech language
I know we
pathologist.
have another one later in the show, and I guess I just learned that.
Yeah,
about you.
we learned something
I
new
didn't
every day.
realize that. Okay. So Arianne is a medical professional turned real estate investor. She co-owns over 2,000 units and has flipped and wholesaled more than 500 properties. She also educates others on building wealth through her YouTube channel, Ask Arianne. So she is a rock star, and I'm so glad to have you on the show.
Awesome. Thank you for having me, Chris and Jamie. You guys are amazing friends, and I always love hanging out with your audience because they usually are amazing people too.
Yeah, we love what y'all are doing too, both on the investing side, but also the education side, just showing folks how to build wealth and create financial freedom for themselves. And looks like, are you at a conference? Are you at the conference that Danny's at?
Yeah.
Okay, yeah. We had so much travel coming up, so I wasn't able to make that one, but look forward to hearing how it is. passive investing. What are the benefits that you're seeing? Maybe because you do certain passive investments yourself, and then also you work with passive investors in the projects you're in. So, and you can flip both sides of those coins. But what are the benefits of passive investing?
Yeah, I think one of the things that I really love talking about is this idea of wealth, right? So a lot of the people that we end up working with have the same backgrounds as us. And not sure how much your audience relates, but I came from a middle class family, right? Maybe on the slight lower middle class side. In the Philippines, my dream was actually to make $5 an hour. Like that was my dream. And this was just 15 years ago. And so, as we've learned so much about wealth and growing it, one of the things that has really shifted the way I think about money and how we can grow wealth is this whole concept of passive income, right? I think for most of us, if we grew up middle class, we were taught to work hard, get good grades, get a good job, and then that was it, right? But that is what the middle class has. We're just supposed to work forever. That's why we're in the middle, right? Like we can't not work. But if you want to elevate yourself to becoming truly wealthy, you actually have to understand a different concept, and you almost have to break so much like subconscious beliefs in your mind about how you make money. And how you make money isn't just trading your time for money. You actually have to understand that at some point you have to take your money and make that money work for you.
Was there an event, a moment, an event, a book, maybe a motivational speaker that broke that message through?
I think the very first time it kind of clicked was when I read Rich Dad Poor Dad.
That's where I was going. For a lot of investors, that's certainly true for me.
Right. Yeah. So if your listeners haven't read that book yet, definitely download it now. Get it on Audible. It will change like the framework of your mind. And it's things aren't going to happen overnight, but like just planting that seed in your mind and just thinking about this difference of like, oh, I don't have to keep trading my time for money my whole life. That's the only way you're ever going to get time freedom. And that's the only way you're ever going to have true wealth. Because think about all the billionaires, 100 millionaires, decamillionaires. Like, you really think they're trading their time for money all the time? How are you going to get to $1 billion doing that? Like, you really can't. You need leverage. And the first thing you have to leverage is the money you do make and making that make more money for you.
And it starts out with discipline, because it really doesn't take a lot to live a comfortable middle class life.
Right.
If you're even with a spouse netting close to or slightly over 100,000, I mean that's in most markets, maybe not San Francisco, but in most markets, it's a pretty good life. But getting some education on how to actually acquire passive assets that you can provide income passively that can grow exponentially over time has a remarkable effect over a 10-year period, 15-year period.
It is. Yeah. I started in just wanting to have financial freedom. I was 2014, so that was like 7 years ago now. And to now live it, right? To actually be able to say that I don't ever have to work anymore because my money works for me. Like, that's crazy to do that in 7 years.
Yeah.
And that's
at your age. But because at your age too, because if you remember in Rich Dad Poor Dad, I think when Robert Kiyosaki was writing that, he was much older than we are today.
Right.
And then I would imagine like most of the people coming to you for this type of education, rough average, what would you say, like a mean or like an average of the age?
Probably mid-30s.
Mm-hmm. Okay. But do you get folks that are coming to you, they're like in their 50s?
Yeah, we do.
And they're still looking for that. But a lot of them think like, man, I wish I would have did it then. But it doesn't take much. It does take action consistently, right?
It does. Yeah. One of our members, they actually started working with us last year, and then they're in their mid 50s and they just retired this year, so it doesn't have to take a whole long time. It depends from person to person, because most people who are in their 40s or 50s have something, right?
Mm-hmm.
Whether it's equity in your home or maybe they bought a few rentals. And our whole philosophy is working smarter with your money, not necessarily working harder. Because to be honest, most of you guys watching are already working really, really hard, right? But it's those little tweaks, right? Little changes in how you make your money work for you. Like one example we talk about in our YouTube and Instagram stuff is like getting a lower interest loan on maybe your renter properties or like a line of credit on your home, and then finding really solid investments. Like the guest right before me was talking about some Class A preferred returns that really in the multifamily space is very, very low risk. So it's almost the best chance you're going to get at that 9-10% return. So if you borrow at 3 and you make 10, look, you make that spread at 7%. And if you do that over all of the lazy money, lazy equity you have in all of your properties and all of your bank accounts, right? Just imagine how much more passive income you can make.
And it makes even more sense now with inflation at 7+%.
Yes.
It's really a no-brainer. Any one point, and then just any final comments you have. So you talked about that person got financial freedom in their mid-50s. In comparison to 65 or 70, they basically bought 15, maybe 20 years of their life back. So you're never too old to start this. But any final thoughts on what folks should do as maybe first or second steps in taking that path from ground zero to at least maybe the education standpoint to understanding how they can become financially free?
Right. Yeah. Well, so there's really a short path, right? So like the first thing we have people do is just look at their financial picture, right? If you go on our YouTube channel, youtube.com/Ask Arianne, you'll see some other videos talking about this. But it's more about seeing where you are. I think some people just shy away from it sometimes, and they don't see that, oh, I actually have this 100 grand I could invest with Chris, right? Like just look at your financial picture and see where there's lazy money that you're not utilizing, and then start talking to the people you meet on these events. Talk to Chris, talk to Disrupt Equity from before, and start asking them how you can start getting involved. Because the beautiful thing about real estate is everyone's so open, right? Like so many people, like people want to help. And there's so many people like us, like Chris, I know you too, like we came from backgrounds where we know where you guys are. Like we were just in your shoes 2, 3, 4, 5 years ago. So it's not that long. And we actually want to help people. So just reach out. Like that's probably like the shortest thing I can say.
Love it. Love it. Well, thank you so much. I look forward to meeting with you all again soon.
Yeah. See you guys soon. Thanks for having me.
Thanks.
Take care.
Good to see you. Have fun at your event.
I will. Bye.
Bye. All right. So great info. I love these conversations. Next we have Rob Trigg. Hi, Rob.
Hey guys, what's up?
What's going on, Rob?
Hey man, good to see y'all. Good to see y'all. Thank y'all for having me.
Yes, thanks for joining us this morning. So
Awesome.
I'm going to go over a little bit about Rob. Rob is the Director of Loan Operations at Jet Lending. After 21 years of service in the U.S. Army, thank you very much for that,
Yes,
for your service. Rob brought his leadership and management skills to the real estate industry. He enjoys educating real estate investors on how to grow their wealth and build financial freedom. So thank you for joining us. Take it away.
Yes, ma'am. Yes, ma'am. Good to see both of y'all.
You too. You too. We're gonna get right to it. These move quick. Passive investing. So you work with a lot of investors.
Oh, I do.
I'm not sure about your personal investing portfolio, but you've been in the game for a while, and you interview a lot of investors in your podcast, but you also work with them, helping them, educating them, providing them with financial solutions. What are the benefits that these investors are talking to you about, or about why they're so motivated and excited to get out there and buy more and invest more in real estate passively?
You know, what I have found out, Chris, in the last year of doing my podcast, we kind of took a little break because I got a baby coming. But hey,
congrats!
We're my time has been every Fridays we've been at the doctor's office, but that's neither here nor there. That's
your world's about to change.
Yeah, well, it's the second one, so
okay,
and we're closely monitoring this one. So the podcast have been temporarily put on hold. But anyways, for the last year, I started that podcast. Everybody that I talk to wants to leave that 9-to-5 job. Mm-hmm. They want to retire early, and they want to figure out how to do it and how they can get there quickly. I always tell people the most passively way that you can invest, hell, you can send money to Jet Lending on them and get a 6 to 8% return, because we accept private lenders here, and we'll put that money to work for you very easily. A lot of investors like that model because at the end of the day, it's kind of a fire, fix, and forget. Mm-hmm. They give it to us. They trust us to use that money and get them a return. I personally have a large sum here at Jet Lending myself because, it's given me a pretty good return, far better than you're going to get sitting in any bank account. That's for sure.
Oh, yeah.
Far better. I mean, 6 to 8%, that's pretty good. Especially when, you don't want to really have to work or do anything to manage that.
And you're not worrying about Russian events or economic cycles, tweets from Elon Musk or whatever, triggering a yo-yo effect on the market.
Absolutely. So that's a consistent, passive flow of money that's coming in every month. If you've got, let's say you've got a self-directed IRA or something like that, we can use those. Or, you just want to give us cash that's sitting in your bank account. It doesn't matter what the amount is. It doesn't matter, it's not going to be $5,000. You're not going to get much of a return. But, at the end of the day, if you've got a pile of cash sitting in a bank account that's not giving you the return you want, or is sitting over at Quest not really doing anything, mm-hmm. Send it over to us. We'll put it to work.
When you're talking with these investors and they're saying they want to quit their 9-to-5, which I mean I totally empathize with. That was me.
Yeah. We talked about that too.
But like, do they go into why? Like for me, from the earliest age I can remember, I was an entrepreneur. I was selling candy to my friends. I was like creating these membership clubs that my friends would be in, and I was selling other things that probably shouldn't be selling at school. So that's been in me. I never expected to have a job. I did, and it worked out great because I made a lot of money, and I learned new skills, and then before I went on full-time real estate. But is there any common themes that you're seeing outside of maybe they just don't like it, it doesn't fulfill them, and
I think a lot. I think times have changed as far as, and this is my opinion. I think times have changed as far as people and the freedom that they want to have. To be able to maneuver and do things that they enjoy and do it sooner than 65 years of age. I mean, you work so hard your whole life, and by the time you get to 65 and get a retirement or whatever you're trying to do in your 9-to-5 job, at the end of the day, you only got a few years left. I think people
70% of your entire life will be spent working and sleeping.
Yes,
and you can't change sleep.
No, you can't take that one away. Hopefully, everybody's getting good sleep. But at the end of the day, I think people are starting to realize that there's pathways to not sit at that job that's draining the life out of them. They want a way that they can go enjoy their kids, go enjoy time with their families, and be able just to have time. Time is the one commodity that we can't get more of, and that's been the general theme to everybody I've interviewed. The 25 podcasts that I did last year, it's time. people want their own time and don't want to give it to somebody else. They want it back in their control. And passively doing that, I mean, you can get long-term rentals. There's an argument, like we said yesterday, for short-term Airbnb rentals. You can set those up for fire, fix, and forget if you do everything the right way up front.
And there are management companies out there that manage those and can take the day-to-day away.
And then private lending, putting it to work and have in a vehicle to where somebody else is managing it for you.
Yeah. Well, one thing that I've told folks is every dollar that you create that's passive is one less dollar you have to work for. Not that you would quit your job. Some people, a lot of people want to. Maybe it's to get a different job that fulfills them, or maybe it's to do, real estate full time. But for every dollar you create that's passive is one less dollar that you have to actively work for. So one rental property making $100 a month, it's not life changing, but that is $100 less that you have to work for. And then you get another one, and then another one. And then of course, real estate has multiple components to it, from a tax advantage, appreciation, debt pay down, and all this other sorts. It just comes with adding that every single, like stacking dominoes. You're stacking another one and another one and another one. And then over time, it doesn't take long. It can grow.
Yeah. I'm going to quote Robert Orfino real quick. If I could take you back in a time machine, 5 years back in time, would you buy real estate at retail?
Oh, Robert. I can hear him saying that. And yeah, it's a no-brainer. Best time to plant a tree was 10 years ago. The next best time is today. Same thing with real estate.
Yeah, I mean, the answer is I would definitely say yes. If I could go back 5 years ago, I wouldn't have sold my rental that I had then.
I really think, and we'll wrap up here. I think even today, and I've told folks, I mean, you'll get smaller returns, but if you just have the cash and you get a good job or whatever, you can pay full retail. And I've had an investor, and I helped him. He bought new construction for rentals. I like to buy things.
I've got guys that do that.
But you can do that.
Yeah. I've got guys that I've done 30-year long-term loans, non-QM loans for, that are buying new construction and putting renters in immediately.
Yeah. I mean, it'll be low returns initially, but the overall wealth and equity play over time, it will work in your favor.
One last thing. If people didn't know that the price of rents are going up, this happened to somebody personally to me. The landlord is renewing their lease, going up $500 in Atlanta, Georgia right now. Now, I know that's outside of Texas, but still, that's how crazy the real estate market is right now. The demand has gone up from, I think it's $1,650, and now they're going to charge them $500 more.
Jeez.
Yeah. So, I mean, it's a good time to be in real estate. It really is.
Especially the landlord.
Yeah.
All right. Thank you so much, Rob. Look forward to seeing y'all again soon.
Thank you, Chris. Thanks, Jamie.
Bye.
Bye.
All right. Good stuff. Okay, so our next guest is Nicole Bako. Hi, Nicole. Thanks for joining us.
Hi, guys. Thanks so much for having me on the show today.
Yeah, we're excited to have you. So a little bit about Nicole. Nicole is an IRA specialist at Quest Trust Company. In a former role, she managed over $80 million in retirement accounts. At Quest, Nicole hosts weekly classes, virtual happy hours, and public speaking events to educate others on the benefits of self-directed IRAs and other retirement accounts. So it's a pleasure to have you on, and I know you have a lot of value to bring to this topic.
Well, thanks
nice
so
talking
much.
with you again, Nicole. So we're in your position. You pretty much exclusively work with passive investors. I mean, with a self-directed IRA, it can't be active, right?
Well, yeah, you actually can have like a rental property and have an active role inside of a self-directed IRA.
Well, no, I meant more the flipping, the wholesaling, and I don't know, maybe that can be done in there, but in talking with investors, clients of Quest, what are some of the benefits that they're looking for, that you find that they're looking for And you can tie this directly into how self-directed IRA works to give them extra benefits. But what are they looking for passive investments?
Sure. So most of the clients that we see go towards these passive income investments. It's kind of the 4Ts that I kind of hear the most. They really don't want to deal with the tenants, trash, trouble, and toilets. Like they have a 9-to-5 job and a family, and like that's just not something that they really want to deal with. They want something passive. They have, so much on their schedule, and that's just not something that they want to deal with. They are kind of looking for that mailbox money. It's not going to their mailbox. Of course, it's going to the mailbox of the IRA, if you will. Those returns are all going back to the IRA, of course, and there's tax savings there. But yeah, and then, another reason I hear is, what if my rental property isn't occupied for a long time? I'm going to have to cover, those expenses and the rent, and I don't want to deal with that. So yeah, I am seeing that there's definitely a trend towards more passive investing inside of the IRAs as opposed to, a more active role in real estate.
So in that trend, are you seeing more of like they're doing loans, almost like a hard money loan themselves, or is it more they're buying in equity positions in properties where they're getting a return and maybe even a kickback on profits?
Lots of like multifamily syndications, or like a REIT, like a real estate investment trust, a private fund, of course, being self-directed, storage units, commercial. So, that kind of that passive, here, of course, that same, let me invest in your in your company, and I'll sit back and take the check whenever it comes in. So those are kind of the things that we see investors doing more often than we have.
So what are some of the benefits of doing that through a self-directed IRA?
Sure. So through a self-directed IRA, of course, all the profits do come in. Of course, in a traditional IRA, the pre-tax IRA, the taxes go in the returns go in tax-free for now, but they all grow tax-free or tax deferred. So at 59.5, the magic age for retirement for the IRS, when they start taking those distributions, they pay the taxes then. And it's taxed at whatever your income tax bracket is at the time. In a Roth IRA, as long as you have the Roth IRA open for 5 years and you meet 59.5, everything comes out tax and penalty free. So, the benefits of doing it in a self-directed Roth IRA, all those returns are coming out, completely free. So that's an amazing way, to build a nice, little retirement nest egg there. So, by doing these passive investments that way.
Yeah, a lot of people talk about doing 1031 exchanges, but the same net effect you have through your Roth, because it is that tax deferred growth or tax free. So that's why we've used accounts at Quest, but we also borrow a lot of money from Quest clients.
Absolutely. We definitely have clients that, hey, I just want to be the bank. I just want to loan my funds out. Of course, people loan money out for all sorts of reasons, but I would say probably the majority is to fund other people's real estate projects if they're doing fix and flips or, buying or seller finance or what have you. So again, that passive way, I don't want to deal with all that stuff. Let's meet an attorney's office and see what, terms we can come to together on this promissory note. And, we have a great system where the borrower can just click on a website, pay that loan back directly to the IRA. So we try to make, of course, as easy as possible. But yeah, of course, we see lots of promissory notes as well.
Yeah, and it really is the most passive way you can get involved, because you can buy a rental property and then let a management company take care of it, but you're still the buck stops with you when a repair item comes up or whatever. Whereas when you're doing a loan or you're a silent partner or equity partner in a deal, it's not perfect, but you're not actively in the day to day, especially if it's a loan. Now, it's not completely passive in the sense that you can just blindly do it without any regard to risk and underwriting. Like, you still got to do that stuff.
Of course, do your due diligence.
But from a day-to-day operations, that part is completely passive.
For sure. I mean, obviously, please do your due diligence, on all investments, on people that you're loaning to, or if you're loaning to a company. But yeah, I mean, for the most part, you set it up how you're going to set it up. You've come to terms with the borrower. This is how it's going to go. This is what happens if you don't pay me back, and it's kind of a set it and forget it, from there.
Yeah. Any other than IRAs? Well, let's talk about people who either quit their job and they have a 401k, or they're self-employed. Are there a couple other vehicles that folks should consider that are self-directed that would allow them to use maybe 401k money, moving it over, or set up within their own personal business?
Absolutely. So yeah, if you have an old 401k sitting around, kind of don't know what to do with it, you're thinking this might be an option for you, we absolutely can roll that over into.
There's got to be thousands of those now, like with the whole COVID and people changing jobs, and there's got to be so much money sitting around like that.
Yeah, so you can absolutely roll that money. You're going from a qualified retirement plan to a qualified IRA, which is a qualified account. So, it's not like a taxable event. So you can absolutely roll those funds over into an IRA to do your passive investing.
Even there's certain circumstances where you could do a conversion to a Roth if you qualify. And then there's a strategy on, I guess, doing that after January 1st.
Yeah, you can always do a Roth conversion. It's taxable, of course, because you're going from pre-tax to after-tax. You want to make sure you're not converting too much, because you could, put yourself in a higher tax bracket there. But absolutely, we can process those Roth conversions. That's a very easy transaction, actually. You just need to make sure you're talking, with your CPA for the amount that's really right to convert for you. And you can convert as little or as much as you want, and we're, of course, happy to help you with that. But yeah, Roth conversions for sure. And yeah, you can roll those funds over from your 401k, really all kinds of things you can do.
Love it. Well, thank you so much, Nicole. It's been a real pleasure. And if anyone doesn't have a self-directed IRA, or you want to learn more, reach out to her. Like, we do a lot of business with Quest, collaboration on events, and y'all are at most of the events we attend. And of course, we're absolutely happy clients. So thank you so much, Nicole.
Well, thanks so much for having me. It was a pleasure. Have a great day.
Take care.
Thanks.
Awesome. Good stuff. Yes, Quest Trust Company is amazing to work with, and yes, roll those self-directed IRAs. Highly recommended. I think we got everybody in our family doing that. But okay, so next we have Tanya, and I don't know if she stepped out or there she is.
There she is.
Tanya. Yeah, I saw your seat was emptying, so I was like, oh.
Sorry, Jamie.
Hey, so Tanya actually joined us kind of was a last minute fill-in because one of our speakers got COVID in our Invested Agents Summit back in January, and we got the opportunity to speak to her, and I had to have her on again because she was just so amazing. So a little bit about Tanya. She is a real estate investor, house flipper, and short-term rental owner in Minnesota. I got the state right? Okay. She started out 11 years ago as a commercial project manager, then moved to residential real estate investing in 2018. So welcome to our show.
Thanks. Hi, guys.
Hope that you you catch your breath.
Yeah, sorry, I was sitting just off the screen because I wasn't.
No worries, and I thought so that's why I'm gonna bring her up, and I bet you'll pop up because you're not the first person that's done that. So yeah, you've got a lot of experience from a personal level, passively investing and working with passive investors. So, what are some of the benefits that whether it's personally or just talked with other investors, that they're really looking for when they're considering passively investing in real estate?
Yeah, so some of the things that I think of, like, I have a lot of conversations with people about passive income because obviously, like being in the real estate investing world, I want people to give me some of their money. But on the flip side, I still have money to give as well because I have accounts. Like I have a 401k account that I can't lend to myself, or a portion of it can't be lent. So I lend it out to somebody else. So when I think of the people that are lending just in real estate, whether it's with 401k, IRA, or their personal funds, I just think about the kinds of goals that they have. Like, I think those are some of the most important things. So if you're like interested in lending your own money to somebody, I think asking questions and finding out what you don't know yet. So, because it's kind of hard when you have no questions yet.
Mm-hmm.
So, like, I've never lent before. So you should be like, whoever you're talking to that you're considering lending to, you should know, like, and trust them, obviously, because that's the person that you're kind of investing in. And then you should be asking them, like, what don't I know? What kinds of things should I be looking for? Whenever I have those conversations with people, I try to encourage them to ask the questions and to just be okay with not knowing things, but also, you know, you got to find out things. Like, everybody has to start somewhere. So just asking a ton of questions is a really good idea on the front end anyways.
Yeah, and I would actually add to that. Listen for the investor, like the person that's sinking your money. Listen for them to ask you questions about your goals, because if they're not asking you what your goals are, I mean, it's not that anything, like, it's not necessarily a huge red flag, but that's part of relationship building, and that's also to help make sure that you're going to be a good partner for them, because it goes both ways. Like, a bad passive lender with like misaligned goals with an investor is going to be a headache for the investor. It's definitely not going to be a headache for the passive investor. So those questions can go both ways.
Yeah, and like on the front end, you want to know, like, as a person that's taking somebody's money as well as a person giving away my money, I want to know how long you need the money for, like what kinds of things, like what are you going to do with the money, and then like those questions, they're so important because you want to know, like, is this person's, like, I encourage people, if it's actually just your savings account money, if something happens at your house, like I'm looking at my AC unit, my furnace and stuff like that, if stuff like that goes out, is this money that you need for that AC and furnace? Because you can't use that, or you don't want to use that kind of money. You can't use emergency money in real estate, or you shouldn't, because this person might need it for a year, 2 years, 5 years. Like, it just kind of depends on who you're investing with. So those are the kinds of things, you're right. Like, you want to know what that person's goals are. And then how can you cater, you know, your use of that money, or your use of giving that away? How can you cater that to me and, you know, my lifestyle, I guess.
Yeah. Now, you know, in any type of passive investment, taxes are a part of the equation, and they never, at least in my opinion, they never should be the primary reason why you invest. But it is a huge benefit, especially if the investor has, you know, strong W-2 income. What percentage of investors, you know, really look for the type of investments that are going to provide them with strong, you know, deductions, that you know, these equity partners that are really looking for passive losses in addition to a strong return on their money?
Yeah, so in my world, I'm typically doing a lot shorter. You know, I don't need a loan personally for more than a year most of the time. So the kinds of tax advantages don't really come.
Yeah, they're more hard money, right?
Yeah, well, no. Actually, they're still, like, it's still a private lender. It would be a person that has $50,000.
That's what I meant. It's an individual person that's
and
like
those
their own
people.
organization.
Well, that's what I meant. I was going to say, most of those people they're not well versed in that. So it's my job to make sure either they're well versed, or that my CPA reaches out to them when we need to actually do paperwork or anything like that, or send them things at the end of the year for taxes. So the people that I use are, again, they're just a little less versed in stuff like that. You definitely get that when I have somebody that's a real estate investor already, that's been around for a few years and has a few $100,000 sitting around. Those are the people that care about that. So I would honestly say it's probably 80-20. Like 80% don't understand the tax advantages, whereas 20% do.
That actually, so that last part, I agree with, and I see it, but that also makes it incredibly important for the passive investor to vet who they're working with, because you said 80% that they're just uneducated on various aspects and maybe to a high degree. But that also puts them at exponential risk of potential fraud if they, and maybe not even fraud, but just not knowing the right questions to ask and how to underwrite the sponsor and underwrite the opportunity, because a well-meaning sponsor could still be incompetent or not experienced enough to execute the plan. Fraud is a wholly different story, but it's still risk.
Yeah, I think it is too. But that's why I had mentioned in the front end, it should be somebody you know, like, and trust. They should have a couple of years experience. If it's not, they are hopefully being upfront about that. Because some people, I remember the first time I ever got money given to me for a deal, and I was super upfront about it. I said, like, hey, I haven't done this deal, or I've only done 2 flips, or this is my background. So I think just vetting the person, like knowing that, like, personally, I give personal guarantees. So if something happens with that real estate, they can come back to me personally to get the money. But I think it's just having some of those things in place. You can always talk to an attorney about it prior, but just asking a lot of questions and actually checking references. Like, I can give references to anybody, but the person that I lend my money to is a flipper that I know, like, and trust. So, like, I know she does her paperwork. I trust her, and that's the risk that I run, though, giving her my 401k money. So you just have to know that it is still a risk, and you can win really, really big, or you can not win at all.
Yeah, and you're typically limited to whatever you invested. You know, so by that, just like you said before, like, it shouldn't be your life savings money. You know, this is your investment money that you could afford to go to zero, which, when done properly, when vetting properly, that's, you know, that's less likely to happen, especially if they have a track record, and if they're providing like personal guarantees and things like that. It adds to the risk profile.
And you can start small. Like, I know plenty of people that you just have this inkling when they give you some money. You're like, I bet you that person's sitting on $1 million, but they only start with 100 or 50,000.
It always works out that way.
Super small. So
always works out. Yeah, and you'll see that it's like you do the first deal and they only had 75,000, and then the next deal they suddenly have like 500,000.
Yeah, which is great. Like, just treat it like you don't have to always give all of your money away to anybody. You should still diversify a little bit. And have good paperwork.
Totally agree. Thank you so much, Tanya. It's been a real pleasure. I look forward to talking to you again soon.
Yeah, thanks, Chris.
Take care.
Thank you. Great having you on again. All right. So next we have our last guest, which is Michael Lee. Hi, Michael.
Yeah, good afternoon, or good morning, rather, still.
Yeah, almost there.
Thank you so much for joining us. A little bit about Michael. Michael is an investor and developer in Houston, Texas. He has transacted over $250 million in multifamily deals, and has helped investors place $57 million in equity capital. So Michael has invested in about 5,000 or 5,600 units across 30 different properties. So, wow. Welcome. It's great to have you on.
Thank you very much.
I imagine a large part of that that number, or not a large part, but that number is probably really bumped up by the property that's right behind you in that background, huh?
It is. That accounts for a good portion of it. But yeah, that's the number for all of my GP deals. But I'm also very active on the passive investing side. So I've done. I think that number is a little bit old. I had 10 properties as a GP, but 22 properties as an LP, and I still to this day continue to invest actively on both. So
what are some of the whether it's personal or just when you're working with investors, what are some of the benefits that you see that that you're looking for, what they're looking for in investing passively in multifamily?
Well, yeah, I mean, I think first and foremost is that thought process there is the passive side of it, right? Which is, someone else is kind of putting in most of the effort in terms of finding the deals and then running the deals And you hear the term mailbox money all the time, and that's exactly it, right? So, and whether it's because it's just fun, you don't have the skill set or the ability or the time to invest in that asset class, right? So it could be because you've got a W-2 job, and so someone else is doing all the work. Or in my case, where I've invested in like an industrial product and stuff like that, and that's not my wheelhouse, but it is a product that I do believe in. And so I want to participate in it, but I don't have any other way to do it. So I have to invest with somebody else that I feel that can, obviously take care of my money and do a good job in an asset class that I believe in.
How important is the tax benefits for? I mean, here I'll preface it with this. In my opinion, tax benefits should not be the leading reason to invest in anything, but for a good investment like multifamily, it can be a substantial secondary benefit. So how important do you see that having on your accelerated returns?
Like you said, it shouldn't be the leading reason for it, but it's a big part of it, and it becomes a bigger part the longer you start investing. Right, when you're first starting to invest, it's kind of one of a secondary thing. But as those gains start rolling up and deals start going full cycle, and you have these gains that you've invested from 3, 4, 5, 7 years prior, and then they start growing in size, and that's kind of what you want, right? You invest at $100,000, and 5 years later it becomes $200,000. So that's $100,000 in gains, and then you got to find a place to put that. Hopefully that you kind of deferred the taxes on that, and then you invest that, and then 5 years later, now it's $400,000, and now you have $300,000 gain on top of your original $100,000. So over time, it becomes much more important, which is what you want. But then now you have to figure out what to do with it. First world problems, right? So.
Yeah, making $1 million in net, say over like a 10-year period or whatever, it's really fun until you see the tax bill, and then you're like, holy cow.
Exactly.
So what are some of those benefits that passive investors see on the equity side, or investing in equity in multifamily from a tax standpoint?
Obviously is a big part of it is kind of the deferring of the tax payments, right? And so, and that can be done multiple ways. If you invest as a passive investor, and you're going to get, in most cases, depending on what your type of deal that you're investing in, but if you're investing in, let's say, an apartment building, you'll get some tax depreciation from the property, and so that'll be a negative, I guess, number on your income tax that'll offset any of the positive numbers from your distributions that come in, and that can be deferred for quite a bit of time, depending on the goal of that property. Some people have refinanced their property 3-4 times in the last 10 years, and so you're getting a lot of the benefit of the growth of the property, the appreciation, and the cash flow in the property, and yet you still haven't paid any taxes in a while, or limited taxes in a while. So eventually that gets recaptured back, and then you'll have to come up with, like we said, different strategies of how to defer that even further, kick the can down the road a bit, whether that's investing in a new property or some of the newer opportunity zone properties. But regardless, even if eventually you do end up paying taxes, there's still benefit, because you're paying that taxes many years later, and time value money, especially now with the inflation that we have going on. We know that this money in the future is not worth as much because of the inflation, right? So
100%, yeah, because that savings, say it was 100,000, so you got a windfall, then you get $100,000 tax savings that you've accumulated over a 5-year period. That 100,000, it should be, if you're a smart investor, that should be making money. So it's almost like the tax money, the government lets you borrow it, and make money on it. So when you pay the 100,000 back, like you actually made money on that, but because you bought a new property and it has tax benefits, like that's where the strategy and a good CPA becomes a vital asset.
Exactly.
We got like 2 minutes left. As someone who works on the GP side, so general partner, meaning sponsor, operator to some degree of a property, when so you know both sides, what are questions folks should ask a sponsor before getting into a passive investment in multifamily?
I think it has to be a fit in the sense that, it has to be the right type of product. If someone comes to me with an asset class that, if as a passive investor, I get propositioned all the time, and it has to be an asset class that I believe in a market that I believe in. But more importantly, I look at the sponsor, and I want to understand what their goals are and how do they work, how do they communicate, how often do they communicate, are they local or close to the property, or they visit the property often or that area often, and how familiar they are with that, and what sort of team do they have behind them. So it's kind of all of the above, but yeah, it can be overwhelming when you're first getting started out. And I think that's kind of why I tell all the passive investors that they really kind of have to just kind of take their time. There's no rush. There's always a fear of missing out. You seeing all the numbers getting thrown out there, and people, and a lot of times maybe you hear it from a referral that someone says they did such and such, and they did so well, and you kind of want to jump in, but just take your time, get educated, and then get to know the sponsors before you jump in.
100%, and that echoes a previous show we did, and the theme for most of the guests was the jockey over the horse. So a good sponsor can take a good deal and make it great. A bad sponsor can take a good deal and lose all your money. So definitely vet the sponsor.
Definitely, yeah. And I've seen that across all my deals, right? So
love it. Any final thoughts?
No, I mean, just for anyone right now thinking about jumping in, it's still a good time, but just be careful and get educated and get to know the sponsors and the deals and the asset classes.
Love it. Thank you so much, Michael. Look forward to seeing you again soon.
All right. Thanks for having me on.
Thank you.
All right. That wraps up another show.
It does wrap it up.
We didn't mention it earlier, but if you go to investedagents.com/community, we have an interactive community of other real estate agents and investors and professionals that you can collaborate with. And we have resources and a database of recommended resources and apps and tools that you can tap into, and even opportunities for group coaching calls with me and our team. So definitely go to investedagents.com/community.
Yes.
And
yeah, it's always been our goal, to educate others on, how to passively invest, how to build wealth, and just create that lifestyle that you deserve. That's our passion. And I highly recommend you join those coaching calls, because it's info that you can benefit from for sure. So
definitely. Yeah. And of course, if you got any questions about anything that was discussed today, and we worked with a lot of passive investors and equity partners over the years, a little over 19 million, shoot us a direct message on Instagram, Facebook, or you can shoot us an email. So investedagents.com, Chris@investedagents.com is the email, or you can find us anywhere at Invested Agents on Instagram or Facebook. So see Timothy Phelps gave us a little shout out. Appreciate it, Tim. Glad you liked it. So we will see y'all next month.
Y'all have a great March.
Take care.
Buy some houses. Invest.